So this is the counting equation. Assets are equal to liabilities plus equity. So what are the assets, what are the liabilities, and what is equity? So these are the three main keywords that we use in accounting, and I'm going to explain one by one. So first of all, there are some assets, and the assets I have divided into two categories. The one is the current assets, second is the fixed assets. What are current assets? Current assets are those assets which can be converted into cash in the short period of time, that is 1 year. But fixed assets are those assets which cannot be converted into 1 year into cash, yeah, and during 1 year. It's for the long term of the business and used for the operation of the business, for the working of the business. We use these fixed assets for long term. We don't buy land for 1 year or 6 months and we're going to sell it. We don't buy furniture or building or machinery or cars or truck for 1 year and we're going to sell it like next year. No. We use these assets for the smooth running of the business for more than 1 year, for the long time of the period of the company. But in case of current assets, we can convert into cash. So what are those? Cash itself is current assets. It's also liquid. Accounts receivable. Account receivables are those that from where that we will get money. When we have sold some goods or any commodities or items on credit to our customers, and definitely we will receive money later on. How much money and from whom we will get this money, that comes under the list, and that list is known as accountable, like accounts receivable. Inventory we have in our stock, in our office, in our warehouse, in our shop, in our business, we have a stock. That is also known as inventory, which is also current assets. Can be converted into cash easily by selling off the stock at low price, can be converted into cash. Short-term investment we have, let's say for 6 months, we have given money to someone and we are earning out of this in the form of interest. Short-term investments can be converted into cash in 1 year. Prepaid expenses. Let's say insurance of our car, we have paid in advance for 1 year, and today we have paid, like, let's say September, October, November, December. It's a 4 months, and accounting period ends on 31st of December, but we have paid for 1 year. Means 4 months is fine. Today is like, let's say the month is going on September, October, November, December, 4 months. Let's say $1,200 I have paid. 400 is okay for this year, but what about the $800 that already we have paid in advance? That is also the current assets. If I stop everything, if I stop and want to get this money back, I can get it. Because prepaid expenses, prepaid insurance. On the other hand, we have some fixed assets like car, trucks, land, furniture, buildings, machinery. So some assets that are divided into two parts. Individual assets, personal assets that you have, like residential flat, jewelry, car. These are the individual, is personal assets. On the other hand, organizational assets, business use assets, factory, building, plant and machinery, corporate office. All these are the example of business assets. We have liabilities. So what is liabilities? Liability is a legal obligation of an individual or a business entity towards creditors arising out of some transactions. Towards creditors, creditors mean the person or maybe organization to whom we owe money. Our business owe money to them. Those people, those organizations are creditors of our company. And this liability arises out of some transactions that we have done with them. We have bought goods on credit, definitely. Now liability has increased. We will pay this money to our suppliers. We have taken loan from bank or maybe from financial institution. We need to pay this loan. The time, the stipulated time that we have set, within that we need to pay this loan. Like assets, we have current assets and the fixed assets. The liability, we have current liabilities, long term liability, and contingent liability. Current liabilities are those liabilities which are normally due and payable within 1 year, but long terms not within 1 year, due after 1 year or more. So long term liabilities are those liabilities which don't due immediately but become due after a year or more. So third type of liability we can see contingent liabilities are liabilities that are payable on the occurrence of some event or contingencies. Like in the future, we don't know what will happen. Some of the unexpected liability may arise. That is the contingent liability. We make a provision for that. Just like we prepare some provision for our house, like for the personal work, we keep some money aside just for some time our car got broken or some breakage in the car or service or major problem in the car or vehicle or house or something. We keep something, some money aside that we don't know what may happen. That is contingent liabilities. So current liabilities, bank overdraft is also a current liability. What is that? We don't have money in the bank, but we are withdrawing that money in excess of the money that we have in bank. For example, $5,000 we have and we are withdrawing $6,000. The $1,000 is a bank overdraft. No doubt we will pay interest on that, but the bank is happy to pay you because that you have credibility, you gain the trust that you worked well during the past months, maybe years. So bank is giving you facility to use bank money. Creditors are those that whom our business will pay money to them. It arises due to some transactions. Bills payable. We need to give money to our suppliers because that we have bought some goods on credit. Short-term debts, we have taken 6 months loan or emergency 20 days loan, 30 days loan from our uh, lenders or from bank. We have taken advances and deposit received. We have some advances and deposit. For example, a renting company receive advance from the customer when customer comes to their shop and deposit for the period. When the customer return car which they have taken on rent, will give this money back to them. That is also become the liability. Some outstanding expenses, when expenses are due but not paid, so that is also a liability of the company. So these are the current liabilities. So now what is the account payable? Account payable is the oral or implied promise to pay off debts arising from credit purchase. We purchase some goods for selling, and if we purchase those goods on credit, definitely we will pay money to the supplier. So first of all, what the goods meaning is? Goods are those item or commodities which are purchased by the business for selling purpose. If I'm buying machinery not for selling, that will become our investment, will come on the asset side. But if I'm buying some goods for selling purpose, that will be the stock, not assets. That will be our purchase of goods or item. Because intention is that we will sell it and earn profit out of selling. So those items are known as goods. If we keep the same article for the long term of the business, become the assets of the business. For example, I'm running my electronic company. In electronic company, I have bought 10 laptops, 10 mobile phone, 10 computers, 10 keyboard and mouse. The laptop that I have bought 10 pieces and 9 pieces I have bought for selling and one piece for I'll keep at the counter at the reception area just to keep like a record of all the business dealings and accounting purposes. That will become the assets of the company. The rest of the stock will become the goods, means inventory, means that you have purchased goods. One laptop is become has become assets and other they are we can say these are the stock. No doubt this is also assets, but one that you have bought as is a fixed assets, but other the stock is the current assets. You will sell it and you will get money. Liquidation will be able to convert into cash less than 1 year, yes. But the laptop that I have put on the reception area, I'm not going to sell it like maybe next month or no. It will remain there for the long time of the business. Account receivable. An asset promise to receive cash in future from customers to whom the business has sold goods or services. That is account receivable. Account receivable is the assets, and definitely we will receive money in the future from our customers to whom our business has sold some goods or services. So that is known as account receivable. Dividend is also one of the term we use in accounting. This is the distribution portion of profit by the corporation to its shareholder. If one company earned profit, out of the profit, this year company declared 10% as a dividend to be declared to its shareholder. So that dividend portion will be subtracted from the profit. Retain earning. What is that? Once the dividend is distributed, remaining amount is known as a retain earning. For example, we have $1,000 net profit, 400 is dividend declared for shareholders, remaining amount will be retained earning. Income statement. The list of all expenses, revenues, and net income, net losses for the specific period. That is known as income statement. Sales, revenue, or gross sale are the same. Sometimes we can say sales, sometimes we can say sales revenue, or sometimes we say gross sales. All these are the terms used for the same purpose, that is sale. It is total amount of income generated by the sales of goods or services while conducting its business activities. It's known as sales revenue. The amount that a merchandiser earns from selling its inventory before subtracting expenses is known as sales. Turnover. Turnover is the total value of what you have sold during the year. Total turnover in 1 year. In 1 year, how much the sale was there. This is also known as sale. Shareholder. So shareholders is a person or a company who owns one or more shares of stock in a corporation. If anyone who have bought share of a company, even one share, will become the shareholder of the company, shareholder of the corporation.